Welcome to the HMO Property Show, by investors for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and today this is going to be the last episode of 2025. And what better way to wrap up the year than to reflect over what's happened and then project over what could happen. And that's the exact same way that I set my goals. And if you've been following me for the last 2 or 3 years, you'll know that this time of year I normally do an end of year goal setting. Let's fly into the next year. Go, 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 go. And if you want that sort of stuff, then just go back and listen to one of the older podcasts, because the information that I shared in them podcasts is still relevant today. However, if you want to know what happened in the Perth market, more importantly, what I think is going to happen in 2026, then stick with us, because I must say that I absolutely nailed what was going to happen in 2025. And if you go back to some of the earlier podcasts of this year, there was a lot of talk about the Perth market coming off its boil. There was a lot of talk about everybody moving to Melbourne, and the heat was going to come out the market and the market was going to drop. And whilst everybody was agreeing with that, I boldly stood up and said, I don't believe that's going to happen for these reasons. And then I predicted what was going to happen, and the predictions came true. Well, not came true. I mean, it was very easy to see, right? The writing was on the wall if you weren't getting blindsided by all of the buyers agents saying, we're going to Melbourne because Perth cooked. The reality is the Perth market at the start of the year was well and truly segregated into 3 different brackets: low, medium and high. And I said that the low part of the market, where all the investors were moving and the first home buyers, a lot of activity in there which was pushing them low socio-demographic suburbs and markets up against that mid-tier. And it was also almost becoming, fathomable that some of these suburbs were nearly becoming as expensive as some, really solid mid-tier market suburbs. And for instance, some of those suburbs like Armadale were becoming almost as expensive as like Success and Hammond Park. It was just becoming bonkers. So what needed to happen, and what did happen, is that mid-tier of the market, from 750 grand to 1.5 mil, $2 million, had to move, and did move, and has moved. And that has pulled the lower bracket up. But the biggest movements have been in that mid-tier bracket. I didn't expect us to be in this position, I won't lie, that we're in right now. Right now, we find ourselves in a worse position than we were this time last year. Less properties on the market, less properties to rent. A third of the market gets sold every single week, according to the REWA statistics. And we are under 2,000 properties available on the market. Absolutely bonkers, right? And REWA throws some stats around saying that a balanced market is 8 to 10,000 properties, but that's when we had 2.5 million people living in Western Australia. Now we've got 3 million people, so surely that balanced market means there's more properties on the market, and means that balance should shift to become a balance, right? So I think a balanced market, and REWA could or could not agree with me, but I think it's between 12 and 15,000 properties now. And with 2,000 properties available on the market to purchase, that shows the imbalance of what's going on out there right now in the market. So prices have shifted, affordability is being stretched, and what used to be considered entry level is no longer cheap. And Scott Townsend, good friend of mine, used to work with us many, many years ago before he went out and set Perth property buyers up. He posted something on social media the other day saying that there was, he picked up one of the last properties that was priced under $600,000 in Perth on a green title block. And that's just basically the reality of it, right? Yes, you can get your smaller villas and units and stuff like that for cheaper. When it comes to houses, houses and standalone houses, what you'd class as a grade A kind of asset, is they're becoming harder and harder to get into if you don't have $700,000 or more. But for 2026, I think it's going to be a little bit different. It's not just about prices, but it's more about who's driving the market and why. So let's just have a quick look back at the 2025, because it wasn't a boom and bust year. It was a kind of reset. Prices moved higher across most of Perth. Rents stayed elevated. Listings stayed super tight and got tighter towards the back end of the year. The market is literally white hot. And why? Because demand did not disappear. It essentially rotated, or as we call it in business, a pivot. So when buyers couldn't buy where they wanted, they bought where they could. And that behavior tells us a little bit about what comes next. Because last year, like I said, the tiers that I spoke about, the low tier, which was the $450,000 to $750,000 bracket, the mid tier, which was the $750,000 to the $2.5 million bracket, and the high was a $2.5 million plus. The problem here now is some of them suburbs now sitting in what looks like mid-tier pricing, or some of them lower tier markets now sit in what would have been classed as mid-tier pricing. So when we think of them different tiers, we're going to have to shift. And this is the same as the balanced market from REWA needs to shift as well, because 8 to 10,000 properties in a balanced market, when there's 500,000 more people living here, that needs to shift as well, the same as the pricing needs to shift. So the problem is that although the pricing's changed, nothing else about them has changed, right? They're still fringe suburbs, they're still first home buyer and affordability driven, and they're still investor heavy, because, you know, a lot of investors don't like spending too much money, especially new investors. More savvy and skilled and experienced investors don't mind, as long as the returns make sense. So price alone no longer really explains market behavior. In 2026, we really need to think in terms of buyer type, not just price. So if we think of the new 2026 market tiers, and that tier one, I'm going to say, you know, 550 to 850, and, you know, still fringy, still affordability driven markets. And typically you're going to be seeing your first home buyers, your investors, everyone that's got access to the grants and initiatives and stuff like that, and then your entry price, and, you know, it's going to be driven by yield as well. And this is the kind of most reactive part of the market, right? The money is relatively easy because it's a low price point, and when it's easy it moves fast, and when money tightens it slows first, right? So growth here in these sort of areas is real, but it's kind of cyclical if you think about it that way. Your tier two, now, you know, it's 850 to 1.6 mil, maybe even like 900 to 2.6, 2.7. I still believe this is the tier that is probably going to matter the most again in this part of the suburb, and not because it's exciting, but because it's where like real life demand is actually living right now. But if you think about it, tier two and this kind of middle section of the market, it's where your kind of working households are sitting, right? And don't forget, Western Australia's got the highest wages in the country, and still got almost the cheapest, if not the cheapest, if you take Darwin out of the equation, it's got the cheapest real estate in the country. And so that means why everyone's saying the market's too hot, the steam's coming out, it's got to slow down eventually. Not particularly. Look at Melbourne, look at Sydney, look at Brisbane, they're still going. Why does Perth have to go? Everybody keeps saying Perth needs to slow down, but why? Why can other markets keep going and Perth can't? So if you think about these buyers, these working households inside the tier two sort of bracket, or that middle bracket, they are normally dual income, so good incomes between them, normally established white collar sort of career, and often got stable employment as well. So even when interest rates are higher, these buyers can service debt, but they don't rush in, right? They are skeptical, typically. And again, markets are driven by fear and greed, so these kind of white-collar, kind of established careers, they can kind of sit on the fence a little bit. They don't rush in and out. They kind of wait, they assess, and they move when the maths works again, right? And that creates delayed demand, not lost demand. So there's still a lot of people in that price bracket right now looking for housing. And you just need to speak to the agents on the ground to understand what sort of demand is out there. Or just go to a home up and you'll still see 25, 30, 40 people queuing up around the block. And the other thing to consider, right, that the buyers in this kind of mid-bracket already own property in Perth. That has probably already gone up in value. Well, there's no probably about it, right? It's definitely gone up in value if they've owned it for the last 2 or 3 years. It is 100% gone up in value. And that means they've got equity. And equity gives them options, especially when they upgrade, right? Somebody needs to buy their home, they'll have to put their house on the market, someone needs to buy it, then they need to buy another one, and that also means that the person that they buy needs to buy another one. So although there's not much on the market currently in terms of housing stock, what we're seeing is volume being sold on a weekly basis, according to the REWA statistics, and anywhere between 800 and 900 properties per week are selling, and we only have 3,000 properties available on the market, and that's a mixture of houses, units, and blocks of land. So every single week, 1/3 of the market moves, and another 1/3 comes on. That is absolutely bonkers when you think about it like that. So people are buying, selling, buying, selling, buying, selling. There's this kind of linked transaction going on everywhere. Yeah, it's just a real kind of interesting part in that market right now. The other thing about these people as well is lifestyle decisions don't pause forever, right? They've got equity, the properties have gone up in value, and now they want to upgrade into the next suburb. Sometimes we call this the ripple effect. And the reason that they do that is because they're not bothered about chasing cheaper prices. They're bothered about school zones, commute times, space and parks for kids, shops, services, restaurants, bars, lifestyle decisions that these guys make. And these pressures, these desires, they do not disappear when rates rise, right? People are still having families are still growing, kids still need to start going to school. Little Freddie G, believe it or not, he's going to pre-kindy in February next year. Can't believe it. My little boy is going to school, and I cannot wait to drop him off at school on his first day. That's why we have built this life. That's why I've worked my ass off to get myself in this position, so I can really enjoy these little moments. And I just can't wait to drop him off with his little bag and his little cap on and just see him run through the gates. Exciting. So again, these people in this mid-tier bracket, they still want to upgrade. And whilst interest rates do not control the market, as in like interest rates come down, or it doesn't, the borrowing capacity style of things in terms of what people can borrow doesn't change massively, but people's perceptions, people's FOMO, and really moving from that fear to the greed side of the pendulum means that they're going to start moving in and start moving and buying more houses. So I still think that mid-tier bracket is going to be the big one that moves, right? And the other cool thing, right, is supply is super, super tight, right? Middle ring suburbs just can't create new land. Infill development right now is almost non-existent. Zoning is restrictive a lot because of, councils need and shires and governments need infill development, and they zone land specifically to be developed by the likes of me and you listen to this call. But a lot of the feasibilities still don't stack up right now, which is why we're still seeing a lot of fringe urban sprawl. And sometimes you've got the NIMBYs there as well. The NIMBYs just resist change, right? So this scarcity protects value, and even when growth slows, it doesn't mean that these people that live in these houses aren't particularly bothered about them going up in value like investors are in the fringes. Excuse me. The data that I found also supports this, right? So independent research continues to show that Perth is structurally undersupplied. Population growth is still running ahead of new housing delivery. That strength doesn't show up in fringe areas. It anchors in suburbs where people live long term and supply is constrained. That is this mid-tier bracket that we're talking about. And then when you think of the kind of upper tier market, $2.5 million plus still, this is a different tier altogether, right? It's not slow in this space because demand is weak. It's slow because supply is almost non-existent. It's almost frozen. There's lots of agents that you'll speak to in that kind of $2.5 million plus sort of market, and they all just say, if you had the right house, we could buy it tomorrow, but no one wants to put their house in the market because they've got nowhere else to sell. And a lot of agents out there right now are doing something where like they're knocking on people's doors and saying, hey, have you ever considered selling your property? Because we potentially got buyers for it. However, we can structure a deal in a way so that you can sign a contract with these guys and get a longer settlement period that suits you to find somewhere else to live, and we'll also help you find somewhere else to live. Real estate agents in this space are generating their own work, and this is, people might look at this market and say the real estate agents are killing it, but because there's very, very low numbers on the market right now, these guys are working harder than ever, and rightly so, right? They get paid a lot of money. And a lot of people in this like top tier bracket, they already live in their dream home, right? They're typically business owners, or they've inherited money and they've moved into these suburbs and they've bought their kind of dream home, and they're not that bothered about moving, so they're not upgrading again. And Typically, they have low debt levels, lots of equity, no pressure to sell. So unless there's a major life event, they just don't put their properties on the market. And this creates a thin to non-existent market. Fewer listings, fewer transactions, strong prices when quality stock appears. And these properties can go like anywhere from $100,000 to $500,000 over list price quite easily. So 2026, what does it look like as an investor or just somebody that owns their own house and you want to know kind of where the market's going to go? So I believe that if rates stay flat or edge higher early, which is a possibility because of the inflation numbers that we're seeing right now, tier one, your bottom tier, there'll be movement in there. Volatility will increase. Your mid-tier sort of bracket, it will slow down. And this is only if interest rates edge a little bit higher, right? But what will happen is, again, people will just move from greed to fear. So the demand will still be there, but it'll just be hidden underneath the fear that's out there. And your tier threes, yeah, they'll just remain selective anyway. A lot of cash moving around in that top end of the bracket, top end of the market. Excuse me. What if rates drop in 2026? The FOMO kicks in. Tier 2 or the mid-tier kind of moves into that next leg. Tier 1, your lower band, that'll get pulled up with it. And then tier 3s will also, like your top tier, that will also kind of increase steadily as well. And I think the key part to think about in all this is the middle doesn't stop. It will only just pause if we see a rate increase, or it might not even pause. I think it'll just slow down a little bit, which, let me tell you, is not a bad thing because it is white hot. Like I said earlier, it is absolutely bonkers out there right now. So I've got a couple of suburbs in each kind of price bracket, which I still think not only can move, but probably will move. And I'll give you 4 or 5 from each kind of price bracket, right? So let's think of your entry level, bottom tier, fringy, kind of affordability driven. I believe some of the bigger movers in 2026 will be Baldivis. Now, don't get me wrong, I'm not a massive fan of Baldivis, but it doesn't mean that the data does not point towards it being a market mover. Ellenbrook, again, not a massive fan of Ellenbrook, but the numbers are looking spicy to make that thing move. Alkimos, right? I've never been a fan of Alkimos. Don't know why, but again, cheaper, fringy, blocks of land, people wanting to build out there, also people just wanting to sell out there and potentially move into better suburbs, and then investors might pick them properties up. Byford and Armadale in certain pockets. These suburbs, I believe, will move when affordability matters the most. So you'll get volume in these areas, but it'll be volatile in the terms of like, these could be the first to move, but these could be the first to move in an upward direction or even a downward direction as well. So if we think about the kind of mid-tier owner-occupied middle, the kind of suburbs that I think will be movers and shakers and seeing some really good areas in, and surprise, surprise, we have got properties in a lot of them, is Bayswater, Yorkine, Morley, Willerton and Borragoon. And the reason that I'm picking them is that these areas combine owner-occupied demand and appeal. There's some really, really good lifestyle drivers, and obviously you've got your limited supply coming through that chain as well. So this is where quality growth will continue to go. And I believe these will be long-term performers as well. And then when you look at your higher end of the market, you know, I think your Cottesloe, Claremont, City Beach, South Perth, Florius, these are more about wealth preservation than speed and capital growth. I think this is just people buying because they want to live in these areas and they've got the capital to do so. So I hope that helps. 2025, what's happened? 2026, what's about to happen? I really think it's just going to be a repeat of 2025. I don't think the market's going to slow down anytime soon. I'll be very, very interested to listen to this podcast back at the end of 2026 and see how the market actually did move. Because I don't believe 2026 is about chasing headlines. It's about understanding who the next buyer is. So, low market, again, driven by affordability. Your mid-market is driven on life decisions, and then your top end of the market is driven on wealth. And the market, in the middle of the market, is going to determine what happens to the top and the bottom as well. Not because it's loud, but because it's where the real kind of input is right now, where the real kind of buyers are, where the real kind of money is, where the real kind of serviceability and borrowing capacity to buy these type of assets is. So yeah, I suppose ask yourself this question. If you tomorrow had the borrowing capacity of up to 1.5 million, what would you be buying? Where would you be buying? What would you be buying? And why would you be buying it? And ask yourself this question. Are you paying attention to the part of the market that moves first? My name is Neil Gibb. I hope you had an incredible 2025. I hope you smashed all your goals out the park. I hope you're ready for 2026. Please take some time off. Please recharge the batteries. Please enjoy the fruits of your labour. And let's go into 2026 hard. And I will see you on the other side. Next podcast will be released on, where is my diary? I'm just going to say mid January. Maybe the 14th, maybe the 21st. I'm not quite sure yet. Depends how good my holiday goes. But keep in touch, guys. Love you all. Thanks for following us. And I will see you in 2026.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.